Hello, Business 635 students. This is Professor Hassey. It's week number 2 introduction video to our work this coming week. Today's date is Sunday, June 14th, 2020, and I'm speaking live and in color from Business Finance Central here in Claremont, California. A little bit later this weekend, I had some late things to do yesterday, but here's our introduction to this week. And this week, our main topic is risk and return. The risk in capital fundraising, the borrowing of money, the issuing of equity, the risk calculations, capital asset pricing model, beta, and also the big risk of the economy right now, currently, the recession of 2020. These all things play into key strategies and key points of financial management. And we'll be talking about those this week on Monday evening. All leading up to a discussion post this week where you're asked to look at the present and future value of an asset, give an example, and also comment on 2 other students' forums and give your comment and analysis of their work as well. So that's all been posted in Blackboard, and we'll talk about this tomorrow evening on Monday. But first, a little video for you this Sunday to get prepped for the week, a little definition of risk and return, and let's watch that right now.
Understanding risk and return. Looking around us, we find that different financial products such as fixed deposits, bonds, and shares give different returns. Why do the returns differ? To answer this, we must first understand the idea of risk. An important principle of investment is higher returns entail higher risks. Risk drives the returns on assets. Fixed deposits earn the lowest returns because they are considered the safest. Shares have the highest expected returns as they are the most risky. Investment-grade bonds have expected returns lower than shares because they are less risky than shares. In investing, there is no reward without risk. If an investment offers higher expected returns, it will generally have higher risk. Suppose investment A has an expected return of 3%. If investment A performs better than expected, actual return will be above 3%. If it performs worse than expected, actual return will be below 3%. Actual return will be 3% only if investment A performs as expected. The presence of risk or volatility means that the expected return can differ from its actual return. The difference between actual and expected returns is risk or volatility. A simple statistical measure for risk is standard deviation. The larger the standard deviation, the greater the overall risk of an investment. Compare investments A and B, which have the same expected return of 3%. As B has a lower standard deviation than A, it will give a higher return to volatility ratio known as the Sharpe ratio. In investing, we aim to maximize the Sharpe ratio, which maximizes return for the same risk or minimizes risk for the same return. Further, to be successful in investing, you must understand your risk appetite. Assess your risk appetite on 3 dimensions: needs, ability, and willingness to take risk. If you plan to retire by 40, you would need to generate higher returns that will allow for early retirement. If you have dependents, your ability to take risk is likely to be lower than someone with no dependents. If you have the need and ability to take on risk, but find it unsettling after buying a risky stock, then willingness is low. You may want to consider investments with a lower risk profile, such as investment-grade bonds. Imagine investing as choosing a roller coaster ride. If you choose a wilder ride than you can handle, you are likely to want to get off the ride halfway, as it is scary when it dives. Similarly, if you have investments that are too risky for your risk appetite, you may panic and quit them prematurely when the market dives. The key to successful investing is the ability to stay invested. If you get off the roller coaster halfway, you could lose your investments. By staying invested, you may also ride out market volatility and business cycles. In the next video, find out more about portfolio diversification.
Now, as you can see in this video, it's taking the perspective of the investor. But now you also can see the challenge of the manager, CFO and whoever, in regards to managing the financial resource to produce this return at the warranted risk. And that's what we'll be talking about more specifically from Chapter 6. How can an investment manager, a CFO, a manager of financial resources, provide adequate return and limited risk? And risk is determined by market factors, determined by the performance of the company, and the current economic policy going on in the world. And today we are in a recession where there's a high degree of risk in the market for loss. And we'll talk about that in our discussions this week. So as we head into week 2, we're concentrating on looking at the determination of risk and how to measure that risk. Beta, capital asset pricing model, as the video explains, the Sharpe ratio, and also determining the amount of value of money based on this risk. The present value, the future value. Is the revenue stream an annuity, equal series over time, or is it unequal? We'll be discussing all this from chapters 4 and 7 this week in class. So I look forward to seeing you tomorrow night at 6 o'clock. I have posted all the grades from last week's discussion 1 work. If you did not get a lower grade, if you got a grade lower than 100, then you have yet to post your bio, or you did not contact me and we did not have an interview one-on-one last week. So we'll move forward. There's a new discussion post this week. We'll talk about that tomorrow night. So thanks everybody. Enjoy your Sunday and we'll see you tomorrow. Bye-bye.